Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell. I'm a senior market specialist at FXCM, and my email address is r.fxcm.com. Today is Tuesday, the 30th of August 2022. I'm going to just bring up our disclaimers. The first one is the high risk investment warning. I'll keep this on screen for a few moments, and then we'll bring up the commentaries disclaimer. Hey, Howard, morning to you. Nice to have you on the webinar. Thank you, everyone, for joining this morning. As always, much appreciated. We do have the live trade on Friday, the NFP live trade. I'll just I'm going to put the link in the chat in a moment. I'll just bring up the market commentaries disclaimer whilst I'm doing that. All right, so you'll be able to find the registration link in the chat if you'd like to join me for that. Here's our references: MarketScope 2.0, CNBC.com. We'll go through the morning article on CNBC in a moment, and then of course we'll consult TradingView as well. I'll just keep this in for a few moments. All right, so the headline on CNBC reads: European markets head for tepid open as investors monitor a recession risk. European markets are heading for a slightly higher open on Tuesday after a negative start to the week following remarks from US Federal Reserve Chair Jerome Powell last Friday. At a top central bankers conference, Powell signaled higher interest rates would likely persist in a bid to tame soaring inflation. In his much anticipated annual policy speech at Jackson Hole, Wyoming, Powell said that the Fed will use our tools forcefully to control inflation, which is still running near its highest levels in more than 40 years. He acknowledged that rising interest rates will cause some pain to households and businesses. Powell's comments were echoed by European Central Bank board member Isabel Schnabel over the weekend. Schnabel reaffirmed the view that central banks must act aggressively to tackle rising inflation, even if that means dragging the economies into recession. Shares in the Asia Pacific also traded lower on Monday and were trading mixed overnight. All right, so that's the those are the headlines. Let's take a look at the real interest rates just to start this morning off. So the real interest rates are at the bottom. We've got the US dollar at the top. This is the FXCM US dollar basket. US dollar basket trading in zone 1. That's between the upper red, upper blue. So that's our bullish area. So prices are going to appreciate. They'll need to stay in zone 1. If they drop into zone 2, which is our neutral area, which is between the two blue, well, that's obviously a relative step backwards. So we just want to monitor that. And the reason that we want to monitor the US dollar, real rate's not doing much at the moment. So after Jackson Hole, one would expect the rates to be a little bit more I guess, aggressive than they're currently being. But they're in the middle of zone 2, and they actually got a very, very short body. There's nothing really happening here, which I found quite interesting. We'll just keep an eye on that. If the interest rates move into zone 1, I think that's, of course, supportive of the US dollar. The real rates themselves, let's actually put the real rates in the top here. And then we'll work with the bottom charts. All right, so we've got the real rates in the top. Let's make this the NAS 100. Okay, so we'll just take a look at the growth side of the market. Okay, and you can see we've got the reference candle here. Okay, so the reference candle on the real rate. We're just waiting for it to move into that zone 1. And what we're going to do is add a correlation coefficient to this, just to see how closely correlated the real rates are to the growth side of the market, the NASDAQ. So let's add that in. All right, so you can see we've got a negative correlation here. So let's just acknowledge that. And what that effectively means is if the real rates continue to move up, it's probably going to push NASDAQ markets down. And that makes sense on a fundamental level, because the time value of money characteristics make the growth side of the market very sensitive to interest rates. What's interesting, of course, is that the real rates aren't really moving at the moment. So I'm finding that quite puzzling, given how hawkish the delivery was on Friday. So we want to keep an eye on this, I think, very carefully. The lack of movement on the market I'm finding very interesting. And the reason that it's very interesting is because often when markets don't move after major announcements, it's telling us something. So what could it possibly be telling us? Right, so we'll go through to NASDAQ here. I'm going to go through to the monthly. And we throw in the COPOC, right? And the COPOC generally used to suggest when there is a potential bottom that is setting up. But then effectively there are two movements in the COPOC that we need to keep an eye out for. And the first movement is COPOC dropping below 0, which we've got. Now we want to see when it turns up. Now I'm not sure when it's going to turn up. Without that turn up, we don't have anything. And what we've done previously is we've just added a 3-month exponential moving average as a signal line, which I think is acceptable. I mean, it's not part of the original COPOC, but just to use it as a signal line, we can throw that in. And the obvious question here is, well, when will it turn up? So in order for the NASDAQ to turn up, one would expect there has to be some sort of moderation or expectation change in terms of moderation of real rates, of interest rates. And unless we get some sort of fundamental shift on the interest rate side, it's very unlikely that there will be a catalyst for the COPOC indicator to turn up. So the question is here, are we going to get the moderation in expectations or not? And it's a very difficult question that the market is dealing with. So the headline that we're reading this morning is European markets head for tepid open because of recession risks. And what we read in that article is, well, the monetary policy is in effect what's going to be causing those recessions. So that's interesting, okay, because it means the higher interest rates purposefully hiked by the central banks in order to control inflation. That's their policy goal at the moment, is the primary concern, and recession is secondary. So again, let's bring up the real rates underneath. But to get your real rates, just subtract your break evens off of the 10-year. Okay. Right. So we want to see this over here is kind of the fundamental mechanism that is standing in the way of a Nasdaq code suggesting a bottom. If we carry on getting the interest rates moving that way, I would expect we carry on getting Nasdaq moving that way, then we're probably looking at a much lower. Then we're probably looking at a much lower COPOC before it kicks up. This is going back to global financial crisis. Okay, let's go back to the tech rec. Here's the tech rec. Here's the tech rec. Okay, so there is certainly scope here for further downside in the Nasdaq before we register that button, suggesting that the interest rates over here could potentially go higher. What's the interesting part? I want to just take us back to the weekly. Interesting part in the weekly is we've had hardly any movement this week. I find that interesting after a very, very hawkish delivery. It lasted between 8 and 9 minutes on Friday. So I just wonder about that. Why are we getting hardly any movement here in the real rates? Kind of are we heading into potential? Are we heading into potential contrarian territory here? What am I saying? What I'm saying is that, well, given the risk of recession, okay, going back to the heading, to the article, European markets head for tepid open as investors monitor recession risks. Given those recession risks, okay, will the central banks be able to move those rates up? Now, the communication we got on Friday was, well, we're going to do it, okay, but the markets suggesting something odd. No movement here. So we want to just keep that sort of in the back of our mind. Now, this market is not an easy market to read at all, because in the background here, we've got this quantitative tightening that's starting to take place. We're now moving into September. September is when the QT is going to effectively level out at that 95 billion, 60 billion treasuries, 35 billion mortgage-backed securities. So let's add this chart into the mix as well. I think it is WALCL. Yeah, that's it. All right, let's add this into the new pane underneath. All right, so this is the big outstanding anomaly that is really going to, I think, be a huge influence on the market, and we want to monitor this very, very carefully. Just going to make it a little easier to see. So what we got here is the quantitative easing of the Federal Reserve. So this is where the balance sheet explodes upwards. We have mentioned this previously, and now you can see. Let's add in a moving average. We're going to add in a That's it. Let's go through to a monthly here. No, let's go back to the weekly. All right, we'll add in a 52-week. Okay. It's just adding a 52 weeks. This is a fairly long exponential moving average. I'll just make it a little darker on the navy side. And you can see that there is this huge convergence taking place here. So what is interesting is if we cross over to the downside over here, we have gone into quantitative tightening. So what is quantitative tightening? It's effectively the Federal Reserve starting to normalize its balance sheet by siphoning liquidity out of the market. Chris did send me an article today. I'll just send it through to you guys. Thanks very much, Chris, where there is a discussion on the M2 money supply. I'll just send that through to everyone. Just let me know if you get it from CNBC. And the article is talking about a massive recession. At the same time, huge inflation. So the huge inflation, according to the article, is because of this blowout quantitative easing here, which moves the M2 money supply up. And now there's no M2 money supply growth, and in fact, we're getting it siphoned out of the economy. And that's effectively increasing recession risk. Well, if it's increasing recession risk, it's going to be very interesting just to see how the interest rates adjust to that. Because recession, one would expect, would have to be met with some sort of adjustment, interest rates lower. But the quantitative tightening suggesting interest rates moving higher, so there's kind of an ambiguity of forces that are kind of meeting each other, one from the recession side, one from the inflation side, with the Fed suggesting that the inflation side is the more important. Market not buying that quite just yet. And if the market's not buying that, okay, then the Kopak indicator on these growth assets become super important, because it puts us again in contrarian territory. Okay, contrarian by definition, we're thinking opposite to kind of the rest of the market thinking, right? It's not a comfortable place to be, but you've got 1 out of 2 measures in the Kopak indicator 1 out of 2 measures in the Copac indicator. We don't have anything without the second one. Okay, so if the interest rates continue moving up, well, then the Nasdaq continues moving down. Then we don't get the crossover in the Copac. There's nothing really to talk about. But if you get a market which is not buying the inflation push relative to recession risks, well, all of a sudden, Copac becomes increasingly interesting on a contrarian basis. So the evolution from Friday through to Tuesday, okay, I think is interesting. And I want to see if there is any build on that, or if ultimately interest rates do give in and start moving up. Okay, and we're talking about the real rates here. Okay, so it puts us in a very, very difficult market, which is exactly what we have said for the last few weeks. This market, just as you think it's clearing up, just as you think it's clearing up, market's still behaving very, very odd. Very, very odd. No movement on the real rate. Isn't that odd? Okay, let's just take a look at some comments. Isn't one of the reasons that real interest rates didn't move is because hikes are already priced in from Rob? Yes. Okay. So if they priced in, Rob. So let's assume that what you're asking is, or what you're saying is correct. Let's say the interest rates are priced in. Okay. What does that imply for us as traders? It means, well, if they all priced in, then the downside is probably pretty near its nadir. We probably should be looking for some sort of turn up in the Copac. That's exactly the contrarian viewpoint, is that everything's been priced in. So we've got these articles that are coming out saying, well, the Feds just put the Nasdaq into I read an article, I think it's off of Barron's, I'm not sure. The Feds just killed the Nasdaq's bull market. And then I read another article just as bearish, and another article just as bearish, and another article just as bearish. But interest rates haven't moved. Okay. In fact, Nasdaq hasn't really moved this week. So what I'm saying is, we don't want to go in and just willy-nilly take a contrarian position. What I'm suggesting is we want to keep an eye on whether the interest rate movement comes or if it doesn't. Okay. Does that sort of answer your question? So again, I'm not suggesting we are at the bottom. What I'm suggesting is that there is strange market movements. We've got 1 out of 2 movements on the Copac. Let's keep an eye on it. Has everything been priced in, or has it? Because if everything's been priced in, this is the time to start thinking contrarian. Because by the time everyone realizes that everything's been priced in, the pros have made their move. Okay, so what I'm just saying is just keep an eye on what's happening. If we start getting interest rates starting to move up in an aggressive fashion, well, clearly then there's still discounting to be done. Then there's still support for a risk-off type of stance, and it puts us in a very fragile position, because we're at that fork in the road. Is the market continuing this this repricing downwards, or have we reached the point where it's time to not go into bargains, because I don't think that's the time, but start looking to see if bargains are available. So it's kind of, when the market's coming down, we want to sort of close shop, take out our fishing rod, and go fishing. Well, maybe now's the time to kind of come back from fishing, sit down at the workstation with a cup of coffee, and just start taking a look and seeing, a lot of damage has been done. What's out there that perhaps is good value? So without actually taking any sort of contrarian action just yet, because we're still watching very, very carefully. Okay, we're still watching very, very carefully. So Anna's saying, but we don't know what the September rate hike will be yet, and that's true. That's true. I think there's a lot of uncertainty out there now. So, but what I'm suggesting is that we've probably got, I think I looked yesterday, we've probably got about a 66% probability of a 75 basis point hike. So that's kind of what's priced in at the moment. I think that the idea of whether interest rates are truly priced in or not will be very much, as the Fed said, based on the data. So we've already started seeing the moderation in PCE. We've seen that moderation in CPI. Now, CPI and PCE, that's not two data points. That's one data point just on two different series. It's two different measurements, right? So the idea here is we've only got one data point of moderation. Next month, we may have another data point of moderation, or we may have another data point that is showing us that the inflation is still very much alive. Then the market starts discounting in higher rates or more aggressive Fed policy. But if we get a moderation here, well, again, I would say perhaps a lot of this may be priced in. Exactly what Rob said. Maybe this is the time to start thinking contrarian, not to blindly just go and allocate money willy-nilly to positions. That's not what I'm saying. What I'm saying is we want to just see if the worst is behind us. And the reason that I'm suggesting as such, and I'll sort of tag on that subject to correction, is that when there's bad news that comes out and the market is not quite reacting to that bad news, it's telling us something. Same thing when we in the third phase of a bull market, when there is terrific news, when there's good news, but the market's not reacting to that, it's telling us something. So just like one data point doesn't really make a trend, one day of a very ordinary price movement doesn't really make a trend either. But it's just after such a strong and forceful 8 minutes, 9 minutes on Friday, nothing's happening. Nothing's happening. That's odd. Let's just see here from Rob. So he's saying there's two perspectives. The index could fall some more, and investing in good companies are pretty close to their bottom. Yeah, so let's just look at it in terms of let's take a look at it in terms of the phase analysis. I think this is actually a really good way to kind of take a look at it. So let's bring this across. Okay. This is from yesterday, so let's take this out. We might come back to that. Let's just talk about the phase analysis. Okay. There's three phases up in a bull market, there's 3 phases down in a bear market according to Dow theory. Okay, so you would have something like that. You would have actually, let's do it this way. You would have a very, very gentle slope for the first phase. This is called renewed confidence. You would have a more obvious slope into phase 2, which should be the sort of most the least volatile of the phases. This is when it's called improved earnings, and then you've got a stage here called rampant speculation, where there's a high volatility. It's kind of when there is tremendous amount of attention being focused on the markets. Generally, it's the renewed confidence phase. There's hardly any notice. The improved earnings, people are starting to notice, and then comes to the rampant speculative stage where everybody thinks it's kind of it's too good to miss out. Let's allocate now. Tomorrow is going to be too late. So that's the 3 phases on the way up. Similarly, you've got 3 phases on the way down. You've got the abandonment of hope. Okay, that's the first stage, called the abandonment of hope. The abandonment of hope is when it's kind of where you transition from that rampant speculative stage where you think, I've got to invest now, I've got to invest today, tomorrow's too late, tomorrow's too late. You invest, and then you don't get the capital gains you're expecting, and eventually you start thinking, maybe I've made a mistake, and you start abandoning that hope. Then you get the decrease in earnings stage, okay, and then you get really the panic selling, this kind of stage, which is a terrible place to be. But that panic selling is what you call capitulation. When you listen to market commentators and they're talking about capitulation, they're really talking about the panic selling stage. Now, once the panic selling stage is done, nobody really wants to touch the markets anymore. There's just been so much bloodshed and pain that there's nobody really interested except the professionals, except the pros that are gently accumulating, whilst everybody has experienced losses. It's now time to reset professional portfolios. So along with the sort of technical Dow theory, there's other clues. So renewed confidence, there's bad news, but the markets have stopped falling, and in fact start showing sort of gradual improvement. Whereas at the abandonment of hope stage, it's like there's good news, but prices are coming down. So there's these sort of tiny little clues that we want to keep an eye on. Now, this phase analysis actually goes in quite nicely with Stan Weinstein. Stan Weinstein's method is, remember, accumulation. There is the markup phase. Okay. Then there is distribution. Then there's the markdown phase. And that leads back into accumulation. So slightly different way of looking at the same phenomenon. So we've got a distribution, and you've got something called accumulation. And then between, you've got your markup. And you would have your markdown here. And Stan Weinstein is also pretty clear in saying who's buying at the accumulation, it's your pros. Who's selling at your distribution, it's the pros. Who's buying at distribution, your novices. Who's selling at accumulation, novices. So there's the sort of inevitably what they call the smart money, dumb money dynamic. And just of interest, it's interesting to consider that we may be in the midst of that kind of a dynamic. So let me see if I can find my charts here. So let's now take a look at this in terms of NASDAQ. Let's clear this one out. We'll keep the COPOC in. Let's keep the zones as well. Let's go back to the global financial crisis. Okay, and we'll look at the tech rec as well, I think. So here's your distribution. Okay, here's your accumulation. Here's your markdown. Here's your markup, right? Take a look at COPOC. Pretty good. So it kind of coincides with the movement from zone 3 into zone 2. So it lines up pretty well between the two indicators. Let's go to tech rec. Yeah. Distribution. This is a little bit more difficult to see. Let's call this one accumulation here. Okay, but we've got the zones to help the interpretation. Mark down, mark up. Okay, and then let's just put in there's the COPOC. Where do we cross? Okay, so we cross here. This one, unfortunately, the COPOC does give an early signal here. It whipsaws. So in of itself, this would have not been a great signal, but when it crosses into zone 2 from zone 3, much better signal. So using this 2 in tandem seems to be quite interesting. And if we go back to where we are right now, distribution, mark down. Another obvious question is, well, is this accumulation? I don't know. We don't know if it's accumulation. I'm just suggesting that, well, if we are thinking in a contrarian terms, I don't think we should discount the fact that this could be accumulation. And if it's not accumulation, that's fine. We would stay in zone 3. I'm just going to go and mute if I feel a cough coming. I beg your pardon. Okay, so where do we go from here? Do we carry on there? Do we move there? Okay, that's the key. And what happens here? Okay, do we move down, or do we cross back up? What's the sort of driving force behind a potential contrarian type of philosophy? The contrarian type of philosophy is, well, whatever everybody else is saying out there, there's too many saying the same thing. We're going to take the opposite side. And that's what I think is happening. There's just a constant deluge of bearishness now. I can't see any bullishness in terms of commentary, articles, etc. And then, of course, the real interest rate not really giving much after such a poignant delivery on Friday. Does that mean that this is definitely a bottom? No ways, of course not. By the end of the week, I could be having a completely different conversation saying, listen, that contrarian position, forget about it. Interest rates are way up. Nasdaq's way down. Let's come back to this at a more appropriate time. But it's something that I think that we need to just keep an eye on, because there is I think a case to be made that contrarian positions here could be the sort of position that the pros, the professionals, are adopting. Valuable companies out there at dirt cheap prices. We'll keep an eye on that. Any questions, please go ahead and type them in. Anything? All right. Just a reminder then, Friday we'll do the live trade. We'll revisit this issue throughout the week. It's just very, very difficult, obviously, to know how close to the bottom we are. So what we're going to do is just really defer to the indicators, COPOC and zone analysis. As long as we're in zone 3, not really much to talk about. We're in the bearish zone. But if we start creeping back into zone 2, I think that would be very interesting, given the tone of the market. All right, there's no comments, so I'm going to wrap up here, and I'll chat with you guys tomorrow. We'll do the crypto minute tomorrow as well. Thanks very much, guys.